Global growth is weakening, and crypto just crashed. What's really happening behind these market shocks? The IMF says growth is slowing, US-China tensions are back, and crypto has lost over $16 billion in value. Let's break down what it all means. Despite the IMF's slight upgrade, global trade and demographic challenges still weigh on recovery. Crypto's collapse wasn't random. Leveraged bets and weak regulation amplified every drop. As we navigate the final months of 2025, the world finds itself caught between two powerful and unsettling currents of change. On one side, we see the vast, interconnected global economy, a machine that powers our daily lives, showing clear signs of strain and deceleration. Foundational pillars: trade, production, consumer confidence, tested by geopolitical tensions, persistent debt, demographic shifts. That affects everyone: national governments, individual households. The question we must now confront is a critical one. Are these shocks temporary tremors, or are they the initial signs of a more profound and lasting economic earthquake? On the other, we witness the volatile and often misunderstood world of cryptocurrency, which has just experienced a spectacular and painful contraction. These are not separate stories happening in isolation. They are deeply linked. Global risk appetite, investment behavior, economic fundamentals, fear, leverage, liquidity are universal languages. Yet the recent crash showed crypto is sensitive to the same forces that govern stocks, bonds, commodities. What does this mean for you? Slower growth could mean fewer job opportunities and higher prices. In crypto, volatility is a reminder. High reward comes with high risk. Scenario A: stability returns as inflation eases, allowing central banks to signal an end to their aggressive interest rate hikes. This provides relief to indebted households and businesses, restoring a measure of confidence. Geopolitical tensions could de-escalate, leading to a modest recovery in global trade and an easing of supply chain bottlenecks, which would help lower the cost of goods. In this calm recovery scenario, the job market stabilizes and then slowly begins to improve. For crypto markets, this period would be one of consolidation. The speculative frenzy would be replaced by a more sober assessment of the technology's utility. Prices would find a new lower floor and trade within a more stable range, having shed the excessive leverage and tourist investors. Regulation would start to provide clearer guardrails, attracting more cautious long-term capital back into the space. For ordinary people, this path would mean a gradual return to a sense of normalcy, with financial pressures slowly easing. Scenario B: another market correction before recovery. In this future, the underlying economic problems prove more stubborn than anticipated. Inflation remains elevated, forcing central banks to keep interest rates high or even raise them further, triggering a deeper recession. Trade disputes could intensify. A sovereign debt crisis in a vulnerable nation or the failure of a major financial institution could act as a catalyst. The economy is slowing, markets are shaking, and crypto just sent another warning. Do you think this is a short-term dip or the start of something bigger? Comment below.